Chris Roberts here, and welcome to the ultimate guide to investing in multifamily apartment syndications, Module 1. Real Estate Syndication Investing 101, an intro to syndication deals and how they work. Many real estate investors get their feet wet through some form of residential real estate. Whether those initial investments are flips, standard rental homes, or even duplexes, that's a great start. But we recently met somebody who's been in the real estate game for 10 years and had never even heard of real estate syndications before. Actually, that's pretty common. Until somewhat recently, SEC regulations did not allow for real estate syndication opportunities to be publicly advertised. This made it so you had to be part of an inner circle. You had to know somebody who's doing a deal in order to invest in one. Luckily, the SEC now allows certain opportunities to be publicly advertised, which opens up the gates for more people to learn and invest this way. But maybe you're new to this term and are wondering things like, what is a real estate syndication? How does a real estate syndication work? Why should I invest in a syndication deal? What would an example real estate syndication look like? Well, a real estate syndication, what's that? Yeah, I know. Lots of stuff, right? Let's start with the basic terms. The term syndication means pooling of resources. A real estate syndication is when a group of people pool their funds and expertise together to invest in a real estate asset as a group. Instead of buying a bunch of small properties, individuals, they put their stuff together and buy a larger asset as a group. Let's pretend you have $50,000 for investing beyond other savings, retirement, and emergency funds. You could invest it in an individual property. That would also require time to find a property, negotiate the contracts, do the inspections, run the numbers, get the loan, plus find the tenants and manage the property. Whew, that's a lot. But it's likely you don't have the time or energy to deal with such an obligation. This is where most people assume real estate investing is too hard and takes way too much work, so they stop right there. Real estate syndications are an alternative that allow you to still put your money into real estate without having to do all the work finding and managing the property yourself. Instead, you can invest $50,000 into a real estate syndication as a passive investor. So let's say you contribute $50,000, maybe a friend has another $50,000 to invest, somebody else puts $100,000 in, and so on. By pooling resources, the group would now have enough to buy not just a rental property, but something much bigger, like an apartment building. As a passive investor, you don't have to do any of the work managing the property. A lead syndicator or sponsorship team does the day-to-day managing, all the active work, and in return, they get a small share of the profits. When done right, real estate syndications are a win-win for everybody involved. How does a syndication deal work? Well, now that you're interested in the behind-the-scenes details of syndications, let's see how all this really shakes out. First off, there are two main groups of people who come together to form a real estate syndication: the general partners and the limited partners, the passive investors. The prior section mentioned a team that would take care of all the day-to-day management so you don't have to, in exchange for a small share of the profits. That syndication team is made up of general partners, or GPs. They do all the legwork finding and vetting the property and creating the business plan. Essentially, they do all the work that you would be doing as an owner or a landlord of a rental property, just on a massive scale. The limited partners, or LPs, are the passive investors, others like you, who invest their money in the deal. The limited partners have no active responsibilities in managing the asset. A real estate syndication can only work when general partners and limited partners come together. The general partner finds a great deal and puts together an efficient team to execute the intended business plan. The limited partners invest their personal capital into the deal, which makes it possible to acquire a property and fund the renovations. Together, the general partners and limited partners join an entity usually called an LLC, and that entity holds the underlying asset. Because the LLC is a pass-through entity, you get the tax benefits of direct ownership. Once the deal closes, the general partners work closely with the property management team to improve the property according to the business plan. During this time, the limited partner investors receive regular and ongoing cash flow distribution checks, usually every month, but sometimes quarterly. Once all the planned renovations are complete, the general partners sell the property, return the limited partners' capital, and split the profits. So why should you invest in a syndication? Okay, now that you've got a decent understanding of how real estate syndications work, let's talk about what's in it for you. There are a number of reasons that passive investors decide to invest in real estate syndications. Here are a few of the top reasons. You want to invest in real estate, but don't have the time or interest in being a landlord. You want to invest in physical assets as opposed to paper assets like stocks. You want to invest in something that's more stable than the stock market. You want tax benefits that come with investing in real estate. You want to receive regular cash flow distribution checks. You want to invest with your retirement funds. You want money to make a difference in your local community. And those are just a few. A real estate syndication is a nearly perfect way for busy professionals to invest in large-scale physical real estate assets without the commitment of time and excessive mental energy, while also positively impacting their community and earning interest and tax benefits. This opportunity for passive income is sounding better and better, right? An example real estate syndication. Okay, so you're interested, but you're still like, is this real? Here's an example of what real estate syndication deals would look like. Let's say that Jane and John are working together to find an apartment community in Dallas, Texas. Jane lives in Dallas, so she works with a real estate broker in the area to find a great property that meets their criteria. And after looking at a bunch of properties, they find one listed at $10 million. John takes the lead on underwriting, i.e., analyzing the numbers to make sure that the deal will be profitable, and they determine that this property has a ton of potential. Since Jane and John don't have enough money to purchase a $10 million property themselves, they decide to put together a real estate syndication offering. They create the business plan and investment summary for prospective investors and work with a syndication attorney to structure the deal. Then they start looking for limited passive investors who want to invest money in the deal. Each passive investor invests a minimum of $50,000 until they have enough to cover the down payment as well as the cost of renovations. Once the deal closes, Jane works closely with the property management team to improve the property and get the renovations done on budget and on schedule. During this time, Jane and John send out monthly updates as well as monthly cash flow distribution checks to their passive investors. When the renovations are complete, Jane and John determine that it's a good time to sell the property, and it goes for $15 million just after 3 years. Each passive investor receives their original capital plus their split of the profits according to the original deal. In this case, a 70-30 split was agreed upon at the outset of the syndication. 70% to the investors, 30% to Jane and John. At this point, each passive investor has received monthly cash flow checks during the renovation hold period, plus their initial capital investment back once the property is sold, plus their portion of the profit split after the sale. A pretty sweet deal for little to no work. In conclusion, now that you know the ins and outs of real estate syndication, including what it is, how it works, how little effort on your part it requires, and how simple it could be for you to begin receiving your first passive income checks, definitely don't wait 10 years to make a move. We always recommend you research until you're comfortable, and that not all your eggs are invested in one basket, so to speak. Now that you're armed with this knowledge about real estate syndications, though, you're miles ahead of most other investors. So keep at it.